Thank you so much for your time on the show, Abigail. Interesting times when you look at how last year played out, especially with money market funds in Nigeria. It's really not the best yardstick to measure the appetite. But you know, what's the current feelers saying in the market?
Thank you, Kenneth. Currently, investors' appetite towards money market fund is gradually returning and looking northward because of the recent increase in the short-term interest rates across instruments like the treasury bills. You see a lot of CPs coming back to the market at double-digit return on investment. The interbank rates are going up, and we see a lot of borrowing in the short and long end of the market at this time. So that is therefore leading to better returns on the average on money market portfolios, and investors are starting to see opportunities there again, vis-a-vis what it had been in early 2021 and most of 2020.
Yeah, but looking at the macro space for Nigeria, I can imagine how difficult it is for you as an asset manager right now to be, playing in this high inflation environment. Can you speak to that investment landscape and how we're seeing it pan out?
So it's no news that most of the instruments in Nigeria right now is suffering from negative real return due to a very high double-digit inflation rate last at 17.75%. Whilst we have even the long-end instruments at lower double digits, around 13% currently for the 2050 bonds. And then for the bills, at the last auction, it was 8.67% nominal rate, translating to a yield of over 9%. However, it's still a far cry from where we are when we look at inflations and when we benchmark with our devaluation in terms of currency. A tough time for portfolio managers. However, with fund managers like ours, who try to leverage the portfolio actively by ensuring that there are other opportunities, trading opportunities to help to bridge the gap against inflation. We tend to see returns closer to the inflation rate and the negative return not as bad as it would have been looking at just the plain vanilla.
But when you look at the entire spectrum, why should investors pick money market funds over other available options right now?
Money market fund continue to provide safety, continue to provide flexibility, continue to give you easy entry and exit. You could do it conveniently, and as such, investors in the short term seek to achieve that whilst looking out for other opportunities as well. So it has provided a short-term option for investors looking for long-term opportunities such that they can be a bridge gap, as they look out for those opportunities in the market. We would continue to unlock other opportunities as the days go by, but we know that the money market fund remains an easy alternative for investors looking for financial inclusion, looking for real good returns in the short term, and also looking for some flexibility around their investment decisions.
But I just want to pick your brain a little on and shake the table a little. And as an asset manager in Nigeria, what would you say is your preferred portfolio asset mix?
Short-term, medium-term, or long-term?
I would say medium-term, bearing the currency risk.
So medium-term, my perfect portfolio mix would be multi-currency, right? And then would have a mix of the bonds, the euro bonds, right? If we're looking at medium-term. And then we'll have some money market instruments and near cash instruments to ensure liquidity to that portfolio as well. The foreign currency component of it would be to hedge against currency risk, which we are really exposed to currently in Nigeria with all of the policies, somersault, and new policies coming out every day, especially the recent one on the BTC ban and movements of about $110 $10 million to the banking space. So we've seen the ripple effect of that policy on the BTC, on our currency pricing as well. So if you have your portfolio, say 20 to 40% in foreign currency, if not up to plus 20% above that, and then you have the FGM bonds long end, because you could see the yields there looking up in recent times, just to create some resilience around the portfolio and to give you some edge when the yields decline. in the near term. And then you have those CPs of about 20 to 30% that could give you the liquidity that you would need to manage clients who choose to exit that portfolio.